Our next guest is pushing back on hopes for September and November cuts, saying the inflation picture remains murky and recession fears overblown. Former Richmond Fed President Jeff Lacker joins us now. Give us a sense of your thinking behind that and the data that you're focused on and what the market might be missing.
Sure. It just comes from looking back at the inflation data over the last year or so. Inflation's been streaky. And I think the last 2 months of good inflation data are hardly decisive. Back in December, when at that meeting and the release of the summary of economic projections, the Fed and Powell got everybody excited about lots of rate cuts this year. They only had 3 good inflation numbers in hand, below 2.25% or 2.2%. Then they got a couple more data, but then the beginning of the year was terrible. 4 months of really bad inflation data. Now we've had 2 months of good inflation data. That seems hardly enough to rule out, a bigger, a resurgence, a return of 3 or 4% inflation. And if you look at the underlying factors, you got wages that are still growing at a rate that's inconsistent with pre-pandemic rates of wage increases, and so it suggests that there's still inflationary pressures in the pipeline. I'd go beyond that. So go on. Yeah.
Oh, no, after you.
I just also mentioned that the Fed traditionally strives to avoid reversing course within 18 months after a rate cut. And they're going to, I think they ought to be cautious about doing that again. And there's a good reason for it, because when they bring down the overnight funds rate, they want to bring down expectations of future funds rate. They don't want people to think it's going to be reversed anytime soon. So that's historically been something the Fed stuck to, and I think that's going to make them hesitant to move until they're pretty sure they're not going to want to reverse course in a year and a half.
That's a good point about the 180 and what that might do for market volatility there. What about the other side of the mandate, though, with regard to the labor market? I know you mentioned the risk of inflation data and some potential lags on that front. What do you make of the current situation with regard to the labor market, especially compared to where we were at the beginning of the year? Some would point to cracks forming in the data there.
So the last year, the labor market was exceptionally strong. If you look at employment growth, came in much better than expected. Second half real growth in terms of real GDP, hotter than expected. What we've seen this year is settling down into a moderate rate of growth, one that's sustainable, really a sweet spot, as Christopher Waller put it. I think that's the tendency. We're not flipping over into a contraction scenario by any means. There's no real signs of that. Sure, the unemployment rate has crept up a bit, but 4% is still a very fine unemployment rate and indicates a job market that, by historic standards, is very healthy and I think sustainably so.
So then I want to ask you a question that Steve asked his survey respondents, which is, kind of given all of that and the picture that you outlined there, do you think that the Fed, if it does indeed cut in September, as the market is expecting, would be cutting too soon, too late, or just right?
I think that likely would be too soon. And I think signaling something at this meeting runs the risk of pulling down the yield curve and setting off inflationary pressures that they didn't intend to, and they'd like to keep at bay for some time. I think that if people got the ebullient sense that rates were coming down dramatically in the next 12 to 18 months, that could stimulate spending, and we could have more spending growth than we really need, and then is consistent with inflation coming down to 2%.